So if you ever looked at a stock and thought, I have no idea what I'm looking at, this is for you. Because most people overcomplicate investing. They look at charts, indicators, hype, but the reality is the best investors focus on a few simple things. And if you understand these things, you're already ahead of 90% of people. So I'm going to break down exactly how I analyze a stock step by step. First thing I look at is revenue, and I keep it simple. Revenue is just the money a company makes. That's it. If revenue is growing, the business is growing. If it's not, that's a problem. Now here's where people mess up. They don't look at growth. Anyone can have big revenue, but is it increasing? That's what matters. For example, look at Nvidia and Microsoft. Nvidia has had explosive growth recently. Microsoft, more steady. Both are good, just different types of growth. And then you've got net income. That's the profit after all the expenses. So yeah, revenue matters, but profit tells you if the business actually works. The key idea is revenue doesn't lie. If it's growing, its business is growing. Next, we have consistency. Because any company can have one good quarter. That doesn't mean it's a great company. What you want to see is smooth, steady growth, not this crazy up and down. For example, Meta, pretty consistent over time. Now compare that to Tesla, way more volatile, big swings, and that usually means more risk. The key idea is the best companies don't just grow, they grow consistently. Now this next step is huge, but most beginners skip it. How does the company actually make money? If you don't understand that, you shouldn't be investing in it. Keep it simple. Amazon, most people think e-commerce, but a huge part is AWS, their cloud computing system. Google, they make money by ads. It's simple. The key idea is simple businesses are easier to understand and easier to invest in as well. Step 4 is looking at multiple quarters for earnings. Don't ever judge a company based on one earnings report. That's how people get trapped. You want to look at least 4 to 8 quarters because trends matter, not one good or bad moment. Take Apple for example. One quarter might look weak, but zoom out, it's a completely different story. The key idea is trends matter more than one bad quarter. Step 5 is future growth. Now this is where real investors separate themselves. You're not investing in the past, you're investing in the future. So ask, is this industry growing right now? AI, cloud, robotics, those industries are massive. That's why companies like Nvidia are booming. The key idea is you're investing in the future, not the past. Now this is where people start to lose money. Just because a company is amazing does not mean it's a good buy, because expectations matter. Sometimes a stock is already priced for perfection, like Nvidia. Insane expectations, or Tesla, historically high valuation. So even if they're great, if they don't exceed expectations, the stock can drop. The key idea is a great company doesn't always equal a great stock at any price. Now always ask yourself, what could go wrong? Seriously, slowing growth, more competition, or overhype, every stock has risk. The key idea about this is you always have to ask, what's the downside? What's the downside when I'm investing in this stock? Can this stock go to all the way down to 0 when I'm investing in it? Or does this stock kind of have a stop loss to it? Now, at the end of the day, if you remember nothing else, remember this. Before I invest, I ask, is revenue growing? Is it consistent? Do I understand the business? Is the industry growing? And is it reasonably priced? Nvidia, for example, fast growth, high expectations. Microsoft is more stable and consistent. Tesla is more volatile, and it's much of a higher risk. These are all 3 different types of investments. You've got one that's fast growth and high expectations. You got one that's more stable and consistent, and then you got the other that's more volatile and more risk. At the end of the day, don't chase hype. Follow the data. Think long term. Because the market doesn't reward guessing. It rewards patience and real growth.